I think realistically, you come up with like $3,000. I think at the end of the year could be achievable if you get more interest rate cuts into the equation. If you get a downtick in CPI, you get the central bank buying, geopolitical tensions remain elevated. I think all those things are there. As far as drawing some lines in the sand, I think, we start going below like 2250. There was a gap in the charts there. If we start going there, I think that it could be a precipitous decline back down to 2000. But under 2000, I think, is a gift these days. We were going into a correction phase. Now, if you look at where all time highs are around $50 in 2011, we're still $18 behind that. And the last time we were at $32, it took about 10 weeks for us to get to that $50 level. So there could be a couple more months to run on this.
Phillip Streible, chief market strategist at Blue Line Futures, forecasts gold prices could reach $3,000 by the end of the year, contingent upon continued interest rate cuts, lower CPI figures, sustained central bank buying, and ongoing geopolitical tensions. This optimistic target hinges on various factors, including future economic data and central bank policies. UBS has also raised its gold price forecast, projecting gold to reach $2,600 per ounce by the end of 2024. While central bank purchases and robust demand from Asia have created a long-term uptrend for gold, uncertainty surrounding the Federal Reserve's monetary policy continues to generate significant short-term volatility. At the start of the week, gold prices rallied to a record high above $2,450 an ounce as markets began solidifying expectations that the Federal Reserve was on track to cut rates twice this year. However, Streible suggests that if gold declines below key support levels, such as $2,250, it might experience a sharper fall back towards $2,000. Despite this, many investors view any price below $2,000 as a buying opportunity. Contrary to these optimistic projections, Commerzbank expects gold to fall to $2,300 per ounce in the second half of 2024. On Friday, gold prices hit a 2-week low and were set for their most significant weekly loss in nearly 8 months, as expectations for interest rate cuts dwindled following a hawkish tone in the U.S. Federal Reserve minutes. In contrast, silver has demonstrated even more dramatic movements than gold, with significant percentage gains. Over a short period, silver prices surged from $26 to nearly $33. This volatility underscores silver's higher beta than gold, often resulting in more substantial percentage changes. Streible highlights that while gold and silver are both experiencing volatility, their trajectories offer strategic opportunities for investors. Join us as we delve into Phillip Streible's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
It's the rising tide that lifts all boats right now. So we're seeing that, the Fed is going to pivot. We've probably seen the peak in the dollar index as of in this cycle right now. I believe that the dollar has just remained elevated because of the chance that the Fed would have to raise rates if you saw input costs like inputs like crude oil, rent, things like that continue to travel higher. But there are quite a few cracks that are forming in the economy. So we're seeing a deterioration in the labor market. The last payroll was like 175,000. They were expecting 275,000. There's been an uptick in initial claims, a downtick in retail sales, not only in the US, but also in China. So it's showing you that the consumer is starting to struggle here. So I think that as far as US equities are concerned, I think that we may be seeing some topping action around these all-time highs. It's nice when all these products are at those levels because it allows the investor, the trader, whether they're long-term, short-term, to really think about things and where they want to go and plan and prepare for the next cycle in the movement in any of these underlying assets. The funny thing about like price targets is that like everyone comes up with a higher one. And I have many of my clients where if gold went to $5,000 an ounce tomorrow, I'd tell them, take the dough. And they'd go, no, Phil, it's going to $10,000 an ounce. So, it's tough to say. I think realistically, you come up with like $3,000, I think, at the end of the year. Could be achievable if you get more interest rate cuts into the equation. If you get a downtick in CPI, you get the central bank buying, geopolitical tensions remain elevated. I think all those things are there. As far as drawing some lines in the sand, I think, we start going below like 2250. There was a gap in the charts there. If we start going there, I think that it could be a precipitous decline back down to 2000. But under 2000, I think, is a gift these days. It's like I feel like they've had everything stacked against them. They had manipulation for so
Absolutely.
many years. I feel like it's bad to say that it's like the rags to riches, because I'm not saying that. Many of these, silver investors are very sophisticated, very wealthy individuals. It's just the fact, I think, the leverage and the velocity behind it, where we can go from something like it was like $22 like 6 months ago, and I couldn't get people to buy it, and then all of a sudden it shoots up $10 an ounce over this time frame, and now we're at $32. So the question is here, is there room to run in the silver market? And I think if you look at it technically, you look at something like stochastics, this is just like a technical analysis guy who would see that, hey, we're in overbought territory, but that just means that we are in a bull market. I would only look for it to come out of overbought territory before I thought that we were going into a correction phase. Now, if you look at where all-time highs are, around $50 in 2011, we're still $18 behind that. And the last time we were at 32 bucks, it took about 10 weeks for us to get to that $50 level. So there could be a couple more months to run on this.
Phillip Streible highlights the recent pivot by the Federal Reserve from an aggressive tightening cycle to a more neutral stance. This shift opens the possibility for interest rate cuts, with projections suggesting 2 potential cuts by the end of the year, one in September and another in December. Despite these projections, Federal Reserve policymakers have emphasized a cautious approach. On Tuesday, they stated that the U.S. central bank should wait several more months to ensure that inflation is indeed on track to reach its 2% target before cutting interest rates. The Fed has downplayed talk of further rate hikes, but noted that the economy still needs to cool further. "We just don't want to go off a cliff. That's the critical thing," said Christopher Waller, reflecting the sentiments of his colleagues. They cited the low perceived risk of maintaining elevated rates for now, suggesting that staying put for 3 or 4 months is unlikely to cause significant economic downturns. Streible notes that the commodities market, particularly metals like copper and silver, is also being influenced by a supply and demand imbalance. The green energy revolution drives the demand for these metals, as do the rise of electric vehicles and artificial intelligence advancements. Over the 3 years from 2021 to 2023, the Silver Institute estimates a cumulative deficit of 474 million ounces, equivalent to 14,743 tons of silver. Let's get back to the interview.
I think the Federal Reserve, they just really pivoted. They changed their policy stance from being, on this tightening cycle to now they're pivoting to a neutral stance. And ultimately, I believe that we'll get 2 interest rate cuts by the end of the year, one in September and one in December. Now, if you looked at just studies back testing since back to 1990, it's indicated that gold futures have rose on average 6% within the first 30 days of that interest rate cut. So a 6% move, given where we're at right now, is over $120. So I think that makes new leaps and bounds over the 2,500 and new contract highs. I don't anticipate that prices are going to come off much from these levels unless something dramatic changes, but it just seems that the Fed is completely content with the elevated inflation right now, and that they're handcuffed from raising interest rates anymore. And I think that the policy path going forward is going to be a bit more dovish. I think that the retail investor has really come into the market, and they tend to
Yeah.
chase things a bit higher. And that's okay when you're in a sustainable bull market. We've seen one of the largest speculative and fund long positions that we've seen in the last 2 years. There's a lot of things that are going on in the background that are helping promote gold, as far as, we're seeing the rising geopolitical tensions. We've seen increased central bank buying. Countries are trying to divest themselves from currencies that are depreciating because of the dilution effect. So, and I think that people recognize that just the irrational fiscal and government spending that's going on, it makes sense for an investor to kind of put their money into more hard assets, things that are a little bit more inflation proof, whether it's real estate, antique cars, collectibles, or precious metals. I think it just makes sense to have a portion of your assets in that. So I always say the secrets when you're trading commodities, that there's 2 characteristics to identify when investing. You want to look for a supply and demand imbalance, and you want to look for market momentum. So the increased electrical power use because of the green energy revolution, along with rising demand for electric vehicles and advancements in AI, which seems to be new technology. It seems like every app I open up on my phone, there's like an AI that's running in the background. That is going to strain not only the electrical grid, but also some of these electronics that are all going to need to be upgraded. That combination pushes the demand for copper, silver, and other metallic metals higher, and that's for the first time in a decade. And this comes at a time when increased regulations, because everyone's so focused on the environment and everything, it becomes harder for additional supplies of copper, silver, to come to the market here and end up at the end user, that it creates this global deficit. So we're seeing almost a perfect storm take place in many of these commodities.
With the Federal Reserve adopting a more neutral stance, how should investors adjust their expectations for interest rate cuts and their potential impact on gold and silver prices? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.